let's go ahead and get started. We're already muted, so that's good. And I hope you enjoy our presentation. All right, so first things first, what is the purpose of this? What will you learn? The purpose is to make sure that you understand as buyers that buying a home starts long before you start house hunting. And our job is to make sure as agents that you are fully prepared to purchase a home, not just the shiny outside, hey, I want to buy a house, but we want to make sure that you're ready for the lenders. Most buyers focus on finding a good house, maintaining a good credit score, but lenders, they typically focus on your financial file. They want to look at patterns. They want to see how, good you are at maintaining your debt versus your income. Of course, keeping your credit score at a certain space, but they want to make sure that your patterns of maintaining your finances look a certain way. First-time home buyers, we want to make sure that first-time home buyers understand how lenders evaluate them on paper, what underwriters care about the most, and how to prepare financially before applying. And then how different loan programs view risk. So understanding this before you apply can save you months of stress and even denial. So we don't want that. We want to make sure that our clients are ready regardless. So this is Team Core Realty and Associates. We are a small brokerage. It's kind of like a family. We're a family-oriented team, and we like to keep it small and personable. There are 8 of us now. Myself, of course, Miriam Causey, she is our associate broker, and she's a realtor. We also have Shaniqua Sean Schultz. She is a buyer specialist. We have Marcia Fagan. She's an experienced real estate agent with Core Realty. She's actually on the call. Marcia is on the call with us today. Bashir Hammonds also is a real estate agent with Core Realty. Of course, we have Keisha Athley. She's a real estate agent and interior specialist. We have Keisha Tillis at Core Realty and Associates. She's an agent and she's an investor as well. Her husband also does home remodeling. So they're a team of investors in home remodeling. And we also have Kimberly Sant, who's part of our team, and she's a real estate specialist as well. So we all work as a team. So when you get one of us, technically you get all of us, and we bounce off of each other. So if somebody needs something dealing with, say for instance, down payment assistance, we might reach out to Keisha because she's, been doing a lot of research concerning that. If we need information about investors, or we're supporting investors, people who have multiple properties or need to do a fix and flip, then Keisha and myself, we work with investors as well, who specialize in those things. And like I said before, Sean, Miriam, Bashira, Marcia, and Kimberly, they're specialists with both buyers and sellers. So you kind of get everything in one. Plus, I also do lending. So I work with clients or any of our agents who may have clients who needs to prepare for a loan or even qualify for a loan. So we try to have a one-stop shop here at Core Realty and Associates where all of our clients feel supported and they have everything they need here. All right. Next, we want to look at the mortgage process and the big picture. And here, basically what we're doing is looking at your total financial snapshot and what a pre-qualification is. Your pre-qualification is a little bit different from your pre-approval. And sometimes people think when you're pre-qualified, that means you're ready to go. I can go ahead, I can buy a house with a pre-qualification. The pre-qualification basically is the processor or the lender looking at all of your documents that you've gathered and you've submitted, and they're saying, hey, okay, based on this basic information that you submitted, the preliminary information, it says, okay, we pre-qualify you because it looks like you can actually afford this loan. But the underwriter needs to go through all of your files to make sure that you're actually pre-approved. So once you're pre-approved, that's actually your green light. Pre-qualification is like the yellow light. It's saying you can ease through. Let's, we want to do a little bit more digging into your files, but go ahead and start looking because things look pretty good, if that makes sense. They want to make sure that your credit is intact. Of course, the higher your credit score, the better for you. The higher your credit score makes it creditors, of course, willing to extend you money, and they want to make sure there's no risk involved. They're looking at your income and employment verification. They're looking at any assets. Do you have any type of assets? Do you own another home? Do you own anything that there's liquid finances, anything where they can pull from financially just in case there's any type of trouble with your loan? Also, you're looking to qualify for different loan programs. So there's FHA, which is government-backed loans. There's a conventional loan, which is typically supported by outside investors. You have VA and USDA, which are also government-backed loans. And then there's non-QM, which is non-qualifying mortgage loans. And then again, we talked about pre-approval versus pre-qualification, underwriting review, conditions, and final approval. And that's typically where, again, once you've been pre-qualified, they're going to go through your conditions, they're going to look at your file a little bit deeper, and then give you the final approval. And then after that, you're ready for your clear to close and closing day. Let me make sure. I want to tackle a couple of details. By the end of this session, by the end of this webinar, you should understand completely how underwriters think, and that's our goal. I used to have this vision that underwriters were, in a little dark room in the back of a mortgage company or bank, and nobody knew who the spooky underwriter was because they're back there telling everybody, no, 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 but you want to understand how the underwriter thinks. And this is what we're preparing you for. By the end of this, you'll know what your credit and income should look like, what assets should look like. You should be able to know what will hurt you in an approval and how to prepare strategically. You'll realize too, if you're ready once this is over. And some of you will be ready and some will need couple of more months. And that's our job. The whole purpose of this is to help you prepare so that you are ready. And either way, both of them are considered wins in our books. All right. This is how the underwriter thinks. Number one, the underwriter wants to know, can you repay the loan? At the end of the day, their job is to protect the bank, not you. I know that sounds, pretty harsh, but it's the truth. The underwriter works for the bank and they're assessing all risk. They also want to make sure, are you stable in your income and on your job? They're looking at the patterns of if you're job hunting, if you're always jumping around from job to job, or switching careers, then they're looking at that because they want to look for stability. They're evaluating your credit. They're evaluating your capacity. Basically, what is your debt to income? Do you have more debt than you have income? They're looking at, do you have any type of collateral? And again, consistency on the job. So underwriters, they don't make rash or emotional decisions. Their risk analysis, and their job is to protect the bank and the private loan investors around the conventional type loans or the non-qualifying mortgage loans. They're basically potentially looking for risk, any kind of risk that you may have. And they literally go through everything with a fine-tooth comb to see if you're risky or not. They want to know, can you repay it? Is an income stable and things like that. We mentioned that before. But they will not approve risky borrowers. They want to approve borrowers that look stable. And so we're just here to make sure you're stable. So once we get started, it's a smooth process for you. Keisha, do we have any questions so far in the chat, or are we okay?
We're okay.
All right, good stuff. All right, so this is your financial snapshot, what lenders collect. So this is where right now, take notes and determine, what do I need to have in place when I even get ready when I'm ready to start applying. They want to determine how much you can afford and issues and inaccuracies on your credit. You're looking at making sure that you have all your documents in order once you get ready to apply. So the first thing you're going to need, of course, is a copy of your driver's license or state issued real ID. They're also looking for your last 2 years of W-2s, last 30 days of pay stubs, and college transcripts if you've graduated within the last 2 years. So right here on this bullet, let's say, for instance, there's a college student or someone who just graduated from college. They are not working. Technically, they don't have a job yet, but they may have a sign-on with the new company that they haven't started with. If they have their college, their diploma, and they have a sign-on with the new company that they're going to work with, the banks can actually use that to qualify you for a loan with no income, believe it or not. So that is, to me, that's an awesome, and inspiring thing for new homeowners and, people who are just graduating from college looking to get a start. They can start with just your degree, and if you have a sign-on with the new company that you're going to be working with. Assets and documentation. Underwriters are looking for your last 2 months of checking account statements, all pages, and they can't be screenshots. So you have to have actual statements downloaded from your banking app or from your app. It has to have, from your bank. It has to have the bank's address, information, everything on the sheet. So if you go into your banking app and you pull down your statements, that's what they want. And you will have to email those bank statements for the last 2 months. If you have any stocks, bonds, mutual funds, 401ks, they need all the pages. So the key is we want to make sure that you're presenting as clean as possible. If they're looking at, screenshots of things, or if you're sending scanned images of documents and a piece of that document is cut off or something is not quite right, they will throw it back. They'll kick it back. So once again, remember I said they're almost like financial forensic scientists, so to speak. They're looking at every little thing and it needs to be detailed. So make sure all your documents are official, legal documents, no screenshots, nothing that the lender could say would be potentially questionable, so to speak. And then they're looking for proof of down payment funds and proof of post-closing reserves. And you're going to see further into the presentation where it's called seasoned money. So they're looking to see if you have any additional funds that may possibly be in your savings account, or again, somewhere in a 401k, or some kind of assets where you have additional funds that's been there longer than about 10, 15, 30 days or so. They're looking for that because what they want to see is that once you close on this property, you haven't used all of your money just to purchase the house. They want to see that you have a cushion. They want to see that you have reserves, just in case if anything goes sour or you lose your job for whatever reason, you have a little bit of money that is still reserved or somewhere sitting that that they would consider you as a stable borrower. All right, next slide. All right, can y'all just give me a little feedback? How do you feel about the information you're getting so far? Thumbs up, yay, nay, in the chat. And I'll keep going. Keisha, just let me know if our attendees are awake. All right, so our next slide is rental and family obligations. All right, so let me make sure, was I on the right slide? Yes. All right, rental and family obligations. If you rent, the underwriter is going to want to see your landlord's name, phone number, and rent verification. So your landlord is, they're basically like a reference for you. So making sure that we can keep up with our rental payments on time, or just basically a good steady tenant. That's some of the things that the underwriter may want to see if you're renting. If you are going through a divorce, or have been divorced, or are divorced rather, they want to see if you're receiving any alimony or child support payments, because all of those things will be considered either income or considered a debt, depending on which side you're on in that situation. So your housing history matters, as well as on-time rent payments. Stability and consistent payments will support your application. So that's what they want to see. Once again, it's all about stability. And court order payments like child support and things like that. The lender looks at those things as obligations for you. So you want to make sure that you're showing all of those things and being as upfront as you possibly can. Nothing where the underwriter or the processor will come back and say, hey, how come you didn't tell us about the house in Malibu that you have? You know what I mean? So those are things that they are looking for you to be upfront with your financials so that you can get a clean clear to close. All right, next we are. If you currently own a property, like I just said, if you own a home in Malibu, but you didn't tell anybody, underwriters will also require current mortgage statements, because that's going to, it's going to affect your DTI, and that's your debt to income ratio. The reason why they need this information is because, of course, there's, property taxes associated. If you have homeowner insurance policies, they're going to require these things because it's going to determine how much you actually can afford in your new mortgage. Your existing housing expenses impact how much additional debt you can handle, if the type of loan you may qualify for. So existing property expenses impact your debt to income ratio. So that's very important for us to know ahead of time. Any questions, Keisha, in the chat? What we got?
No, we're good.
Keep rolling. I'm gonna keep rolling. All right, here we go. Self-employed borrowers. And this is always so much fun for us because, this is where more scrutiny comes in. This is where the underwriter is a lot more stringent They're paying attention to everything in detail because it's very hard to determine where self-employed money is coming from. So what they'll need from you will be more documentation. So instead of the last 2 months with a W-2, they're going to need the last 12 to 24 months of business and personal tax returns. And it just depends on the lender and whatever it is that you do in your business, they may go back further. It may be 36 months. So 12 to 24 months is not written in stone. They may go back further, and it just depends on the underwriter and what they're looking for, or what they need from you based on the type of work you do. And the returns must show your net profit, not excessive write-offs. And the reason why they're looking for your net profits is because you may gross $200,000. I'm just giving an example. You may gross $200,000, but you wrote off 150 of that $200,000. So technically, you've earned $50,000. That's your net. That is what they're going to base a mortgage on, base your mortgage off of, is the $50,000. So if you have excessive write-offs and your business doesn't look like it's making much money, that's going to be something that they're going to pay attention to. Again, 12 to 24 months of bank statements as well, because that's what's going to support the last 12 to 24 months of personal tax returns. And this is the Underwriters reality checks. Tax deductions reduce taxable income, but they also reduce qualifying income. So again, underwriters are looking for the income that qualifies you to get the loan. So, I know that there's so many benefits to being self-employed, and we can write off so much, but when you're getting ready to purchase a home, you want to make sure that your income is showing. We make money, and I know there's a risk there with paying back more in taxes, but if you don't look like you have anything on paper, then of course the lender is going to look at this. Okay, you might make $50,000, but we'll grant you a loan based on $50,000 worth of net income. Does that make sense to everybody? Thumbs up or anything? All right, keep on moving. All right, your credit, what the underwriter sees. So underwriter is going to pull from all 3 credit bureaus. And now there are a ton of different types of FICO scores. And FICO scores it's pretty much a business. It's no different from going to Kroger's versus Publix versus Sprout versus Whole Foods. They're all individual companies, and they monitor your credit. And so each one of these companies, their numbers mean something different. And mortgage companies, they typically pull from your FICO scores, which are FICO 2, FICO 4, 5, or 8. I think the mortgage company we work with, Texana, we use FICO score 8 or 10. And those are typically what underwriters pull from. Car loan, if you were trying to buy a car, they may pull from a different FICO score. So be careful when you're checking your credit and you're using Credit Karma, and Credit Karma may be using a FICO score that underwriters or mortgage loan officers are not using. So the key is to make sure your score looks pretty consistent throughout all of the credit bureaus. So let's see. Here, your Vantage Score 4.0 and FICO 10T are new models that take into an account additional scores of data, including rent payment history, and have the potential to accurately score more Americans. So again, creditors or lenders, they're looking at several different FICO score modeling, credit monitoring companies. However, they pretty much stick to 2, 5, 4, and 8. I thought I had this on here, but if you go to free annual credit report, you will be able to get yourself a free copy of your credit report every single year. That way you can look at it, make sure that everything on your credit report is accurate. You also want to see if you can get a copy of your current credit score. And what underwriters evaluate is your middle credit score. So if Equifax is saying you have a 700, Experian is saying you have a 650, TransUnion is saying you have a 680, they're going to look at the middle score, and the middle score is going to be 680. And that's still a good score to get qualified for a loan. All right, so they're looking at payment history with your credit score. They're looking at utilization ratios, the length of credit history that you do have. And that's very important, because if you're only showing that you have been reporting credit for only 6 months, that's not enough for a lender to see that you have credit history. So the longer you have credit history, the better it is for you, because now they can really have a timeline, and they have a financial trail, so to speak, to see how you are in maintaining credit. Also, they want to see the types of credit you have. So if you have a variation of credit files, or types of credit in your file, for instance, revolving credit, meaning card notes. They want to see possible card notes or credit card, or something where you've been able to pay it not completely off, but keeping your credit ratio down underneath 20% is excellent. Some people say 30, some people say 20. I tell my kids, if we can try to stay under 10%, that's great. They just want to see it moving. It doesn't all have to be paid completely off, but they just want to see that it is lower than what you're bringing in every month. And then they also want to see recent inquiries. Why is this important? Because if your if your credit is showing that you have multiple inquiries and multiple denials, they're going to look at that and think it's risky. So let's say, for instance, someone was trying to buy a car, and they're going to several different several car dealerships, and each car dealership is denying them. And you have 10 inquiries within the last 30 days, then they're going to look at that as risky, and they'll question you about those things as well. So again, the key here in this slide is that your score matters. It does matter, because the higher your score is, it will give you a better rate. It gives you a better interest rate. It also helps the lender to see that you're much trustworthy. You're trustworthy. The lower the score is, doesn't mean that you can't get qualified. It just means that you may have a higher interest rate or a higher down payment. So what matters to them more than just your score is your patterns. And that's what they're looking at. So you could have a 680 score and good behavior, with good behavior, versus a 720 with late payments. So that matters. Any questions?
There are none in the chat.
All right. Total monthly income, qualifying income. This is what they're qualifying you on again, and this is going to kind of be redundant based on what we mentioned earlier. This includes your base salary and hourly wages. This determines overtime, but your overtime must be consistent. So if you're, working overtime, but the only time overtime is showing up on your W-2s, I'm sorry, on your pay stubs is once every 6 months, that's not necessarily something that they can consider. They want to see that if you are getting extra bonuses or overtime, that it's showing pretty consistent. Your bonuses, 2-year history typically. So they want to see if, what's this bonus just kind of sporadic, or is this something that your company does regularly? And if it's something that they do regularly, then they're considering that as a plus because now the company is showing interest in you, it seems stable, and you're holding a 15, 20, 30-year mortgage possibly. So they want to see that whoever you're working with is invested in you as well. Child support or alimony. Once again, these are all considered qualifying income. These are things that you can present to them that this is consistent income that you have coming in. So if you got a 2, 3, 4, 5-year-old, and you know that you're going to be getting this income for the next 15 years or even 20 years, who knows? If you're going to be getting this income from your spouse, that is qualifying income and alimony as well. Social Security income is qualifying, and so is pension or retirement income. So all of that can be used to support you getting a mortgage loan. And I'll say this, let's say, for instance, you're a caretaker and you're caring for an aging parent, and you are that parent's, what's the word that I need to use for this, Keisha? Because I forget it. If you are the advocate for the parent, or you're technically,
The POA?
POA, yes, thank you.
Mhm.
Thank you. You can also say that because you're taking care of this person, you're caring for this person in your home, and that person is receiving Social Security or pension or whatever, that income can also be used as qualifying income for you to get a loan, because technically you're the caretaker and this money is coming into your home, your account, on behalf of the person you're caring for. So they would just need to see supporting documentation that you are you're qualified or you're able to receive money on behalf of the person who will be living in the home with you, because their income matters as well. Key rule, income must be documented, consistent, and likely to continue. So that's pretty much all self-explanatory on your qualifying income.
Toya, can I read a text from Miriam?
Yes.
This is in regards to inquiries on your report. It
Okay.
says, if you are a co-signer for somebody and they have multiple inquiries, it will affect your credit score.
Thank you, Miriam. Okay, that's good. That's really good. So I know I think it's, I've heard this several times before, but I believe it's biblical too, that you shouldn't co-sign for anybody. If you, it's one of those things where you put yourself at risk tremendously for co-signing. So, if you do have to co-sign for someone, make sure it's somebody who is responsible. Absolutely responsible. Okay, we're on to slide 12. Is that it? Yeah, let me see. Yeah. All right, total assets, what actually counts? So you got qualifying income that they can qualify with, and then what counts? Your checking account, they want to see documents again from your checking account, savings accounts, investment accounts, retirement accounts, and gift funds with documentations. And they'll confirm that the source of the funds, and again, remember I mentioned seasoned money. So you don't want, funds in your account from, Uncle Bobby, who might be dilly-dallying on the other side of his life, but he's using your account to clean his money, and he's dropping you, $10,000, $20,000 once a month. They're going to want to find out where that money is coming from. So if anybody is giving you large amounts of money sporadically, they will start to trace that money. So they'll look at that. They'll ask you where this money come from. And if you say, oh, my uncle, Bobby gives me $20,000 every 2 months. All right, we need Uncle Bobby's account. The underwriter will do that. They will reach out and ask for whoever is dropping that money into your account, because they want to make sure that there's no money laundering going on. So they, of course, are going to source all of your funds. And again, they want to make sure you have sufficient reserves after closing. Cash deposits are always harder to document. So just make sure that everything in your account is traceable. So if let's say, for instance, you have a side gig and you're getting payments from PayPal, Venmo, Cash App, who else? Square. Say, for instance, you're, selling purses, or you're doing hair or nails, or whatever the case may be, on the side of what you do from your main business. And if your checking account is showing that you're getting these Venmo payments or Cash App drop-ins or PayPal drop-ins, the underwriter is going to want documentation from your PayPal, Square, Venmo, Cash App account. So they're going to want to see that as well. And then they'll want to know, is this side business reporting this income? So is this a W-2? Is there, a 1099 attached to that side income? If that income is not enough to actually qualify for tax returns, then it's not a big deal. If it's less than $6,000 in income that you're receiving that year, that's not taxable income. It used to be 10,000, now it's 6. I just learned that from my accountant. So that's new. I thought it was $10,000. If you were making less than $10,000, you didn't have to report it. But if your side job is making $10,000, or $6,000 or more, it's got to be reported. All right. Now, total debt. What is counted against you? Your total debt is going to be considered your car loans, credit cards, student loans, personal loans, tax debt, existing mortgages, and again, child support or alimony obligations. Every month obligations count, even if you plan to pay it off later. So it still matters. With a car loan, if you have less than 10 payments left on that car, then they may scrap it. They may not consider that going towards your debt to income ratio. So if you're house hunting, and we tell people this all the time, the minute you get qualified for a loan, pre-qualified, don't buy anything. Don't touch anything. Don't go to Rent-A-Center. Do not try to purchase a car, anything. Act as if your bank account is dormant, and the only thing you're using it for is your regular essentials. But don't pull out any, don't qualify or try to qualify for any additional loans, credit cards, or anything, because now that is going to completely shift what your debt to income ratio will be for getting this mortgage. let's see, minimum credit card payments, car loans, student loans will all affect your approval power. So make sure that whatever it is when you apply for the loan, that's what it needs to be by the time we get ready to close, and nothing else on your credit report. And again, here we are with the debt to income ratio. So this is how you will determine, and this is something that you can write down for yourself. Your debt to income ratio is whatever your monthly debt is. So if you tally up everything, all of your debts, and remember we said that that's going to be car loans, credit cards, student loans, personal loans, tax debt, existing mortgages, and child support. Those are the things that are going to go towards this debt to income ratio. You're going to add that up and divide it by what your gross monthly income will be. So if you know you make $5,000 a month, for instance, and you have $1,500 in monthly debt, you're going to divide that monthly debt by your gross monthly income, and you're going to multiply that by 100. And that percentage, whatever that percentage may be, is your debt to income ratio. So really quickly, just for the sake of having those numbers in your mind. So remember I said 1,500 is what your total debt is. And we're going to divide that by the fact that you make $5,000 a month. Okay. 1,500 divided by $5,000 times 100, and that equals 30%. Okay, so that is your DTI. That's your debt to income ratio. Which is excellent, okay, because FHA wants to see that your threshold for debt is between 43 to 56% of your income. And FHA is much more lenient on your debt to income ratio. It's a government-backed loan, and it only requires you to have 3.5% down. And most first-time home buyers go with the FHA loan because it only requires, 3.5% down, as well as it has a higher debt to income ratio. And you're considered a first-time home buyer every 3 years. So if you haven't owned a home in 3 years, never owned a home, you're considered a first-time home buyer. With a conventional loan, your debt to income ratio is between 36 and 45%. So, again, right now, if you're within the calculations that we did a second ago, you're still excellent, really good. VA is flexible, but residual income rules apply. And then with USDA, it has to be under 41%. And non-QM loans, which is, this is a type of non-qualifying mortgage loan, which they don't necessarily consider your, they're not looking at your bank statements, or I'm sorry, they're not looking at your W-2s. They're going off of your bank statements alone. So it's several different programs under this non-QM loan, and we'll do a additional webinar on the types of loans later on, but this particular webinar is specific to how to prepare. So the key is the lower your debt to income ratio, the stronger your approval odds are. So that's very important to understand and to know. All right, here we go. Where are we at? All right, so we're choosing the right loan program. Again, FHA, USDA, and VA are all government-backed loans. They're, typically deal with lower credit score tolerance, higher mortgage insurance, ideal for first-time home buyers and limited to savings. Your USDA loans are for rural. There's a specific map that determines if you qualify for that home qualifies for a USDA loan. So it's going to be rural eligibility, income limits apply, and zero down payment. But this means that that property has to be, in a very rural area. For instance, like my family is in a portion of my family is in Americus, Georgia. That might be considered in a USDA area where you might be able to get a loan in that area, but we will have to look at the map to be sure. Conventional loans, of course, they have higher expectations because conventional loans are supported by outside investors who are bringing money together to qualify you for this loan or give you a loan. And they have lower long-term cost, and it's best for strong credit profiles. So good credit and strong income. Non-QM, these are bank statement loans. Investors or complex income borrowers typically can go with a non-QM loan. So they want to see that you consistently make the money. They're not particular on your tax returns or if you have a W-2, and they typically have higher rates and more flexible guidelines because they know you have the supporting income to maintain that mortgage. And VA is really good. If you know anybody who's a veteran, or if you're a veteran or in the military right now, VA has no down payments, no monthly insurance, and they have strict eligibility but powerful benefits. All right, we're good on questions? All right, just a couple of more slides, people.
Sorry, Toya.
Oh, no, it's okay.
Denasia has a question. I think we can answer it now.
Okay.
The question is, does student loans have a big effect? Impact, sorry.
Impact, yes. So they can. And right now with, the deferment program that they're dealing with now, with the student loans, most lenders know that majority of the country has student loans. And what they want to see is that somewhere in there, you've been making some payments on that loan. So you want to either make sure that you have documentation showing what your deferment looks like, if that student loan will eventually be forgiven or it has been forgiven, and then if what that student loan payment is. So if you worked out something with your lender, your student loan lender, where your payments may be smaller, then that will be something that the underwriter would look at and see, how it fits into your total debt to income ratio. So it's all going to be contingent upon each individual situation. So your student loans, you may have, I'm just throwing out a number here. You may have $15,000 in student loans left to pay, but you've worked out something with your lender there where your payments can be low, like $20 a month or $100 a month or whatever the case may be. But if you're making more, again, it's all going to be contingent on what that ratio percentage is, including whatever that student loan payment plan. So remember, even if you have a large student loan, what they're considering in your debt to income ratio is what your payments are monthly. That's going to determine, how much that student loan impact will be on your report. Did I answer that okay, Denasia?
Yes, I typed it in the chat, but yes.
Okay. All right. Good stuff. Good stuff. All right. Here we go. We are on. Oh, did I go back too far? Yes. Yep. All right, here we go. Now we're on location matters, and this is pretty big. And the reason why locations matter, underwriters factor in county loan limits, USDA eligibility, like I mentioned before, property tax rates, and insurance costs. So each county or city may have different taxes. And you may say, for instance, you find a home in the city of Atlanta. However, it may be in DeKalb County. A portion that property may be in DeKalb County, but it's registering as city of Atlanta. Well, you may have a county tax and you may have a city tax. And so what the bank wants to do is determine where exactly are you purchasing a home, because we need to factor in your mortgage what the county taxes are, if there are loan limits, depending on what type of program you get. And I think, Keisha, that may have been in the in your down payment assistance program. Sometimes they do discuss, if you're going to purchase a home or use certain programs, it needs to be within a certain area or certain city limits. So you're
Correct.
Okay, so your underwriter needs to know exactly where it is, because Atlanta may have programs where you may be able to purchase this home with the down payment assistance, but it has to only be in the city of Atlanta in a specific area or zip code in the city of Atlanta.
And Toya, I think they have like incorporated and unincorporated. Like
Yes.
Stone Mountain, you have like the city of Stone Mountain,
Mhm.
which is incorporated, and then you have the outside area of city of Stone Mountain. The city of Stone Mountain, they pay county and city taxes because they're incorporated.
Okay, so that would be like where the downtown Stone Mountain is?
Yes.
Okay. Okay. So you see, those type of things matter even when you're qualifying for a loan. The underwriter needs to know all of those different things, because your mortgage is going to break down each one of those in your mortgage payment. You're going to have to pay insurance costs, property taxes, and the property taxes, again, like Marcia just mentioned, could be split. So you may have, several different tax brackets where you need to pay just in your mortgage. So those are things that we need to know. So before we start house hunting, before we start pulling our papers together to get qualified, you might need to let your agent know what area you'd like to be in. That way your agent can research that city and research the laws, or research the county to determine what you will be paying in taxes once you start searching for that home.
Hold on, Toya. Shatoya I think she was asking, was that Cobb County or Fulton County? That is, Stone Mountain is considered what?
DeKalb County.
DeKalb County, yeah.
Mhm. Yeah, but
But
again,
that will work within any county, because
Yes.
like the city of Decatur, you have the city of Decatur, which is like over there by Decatur High School. But then you have Decatur over there off Candler Road, over in that area, that's unincorporated Decatur. So they will only pay county taxes. But the city of Decatur, which have their own city police, you're going to have to pay city taxes and county taxes.
Yes. Okay. And that's so important. And I think the same thing goes for Cobb County, like you said, anywhere, because I know in Johns Creek, that's right on the edge of Gwinnett and Fulton County, but they're, like you said, incorporated. So it just depends on where you go. Your agent has a responsibility of finding out what those taxes will be for that particular area. So that's so important to understand and know. Thank y'all for that. All right. And then I think we have now we're at the final straw. Your pre-qualification is now moving to pre-approval. So remember, we mentioned earlier in the presentation that your pre-qualification is basically self-reporting information. No underwriter is technically reviewing or involved yet. You're at the starting point. And this is where with Texana or any bank that we work with, Texana, you go through what we call the processing portion in the beginning. We'll send you an application. That application is technically an app, and you would upload or submit all of the documentation that Texana needs from you. And it's really, really simple. It's really easy. As long as you have your ID, your forms that we're requesting, W-2s, bank statements, anything that they're requesting in that app. Once you submit that, it immediately goes to our processor. And what the processor is doing, they're looking at all of your documentation to make sure you have everything ready for the underwriter. It's almost like they're preparing the meal for the underwriter, and everything needs to be there so that once they present this to the underwriter, they have no reason to come back and say, hey, you're missing this, you're missing that, we're missing that. And what that does is it delays your delays your approval, and it delays you actually closing. So the stronger you are in your documentation, the easier, quicker, and smoother you are as far as getting approved. Let's see, pre-approval, this is where documents have been verified by the processor as well as the underwriter. Your credit has been pulled, and in your application, it's going to ask for you to allow the bank to pull your credit. So the credit has been pulled, your underwriter has reviewed all documents, and this is where you have a stronger credibility. So pre-qualification is an estimate. It's the starting line to continuing your approval process, and pre-approval is where you're verified. You get your blue check mark, and sellers they strongly take pre-approval seriously. So once you have that pre-approval letter and you find a house and you're out with your agent, you found the one that you want and they are ready to submit an offer, agents cannot submit an offer without a pre-approval letter. You have to have some form of proof of funds, whether if you're a cash buyer, if you have hard money lending, or even if you have a traditional pre-approval letter from a mortgage company. Your agent has to have that letter in order for them to submit an offer on a home. We even want to make sure that you have this letter before we start shopping for a home. So, and the reason why we want to do that is because we want to make sure that you're genuinely ready. You know how much you can afford in a home, and our job is to make the process move quickly and smoothly for you. And your time is important, and so is your agent's time. And we want to make sure everything is going as smooth as possible. All right. And here we go with underwriting and conditions. Your underwriting reviews include full documentation, full document validation. They're assessing your risk, conditions issued, missing documents, explanation, and verifications. So there may be a situation where the underwriter may say, hey, I only have, the last month of bank statements, or I need an explanation of funds or explanation of, let's say, verification of employment. They need that. They may need to determine if the bonuses you're getting are consistent or not. So this is where underwriter is going through all of the fine, sifting through your files. And these are some common conditions that you may get. They need that letter of explanation. Where did these funds come from? Who is Uncle Bobby and what does Uncle Bobby do? We need Uncle Bobby's bank statements. We need updated bank statements. Now, this person's, initially was pre-qualified in February and they still haven't found a house and it's June. So now we need updated bank statements. So the longer it takes for you to find what you want, the underwriter is going to keep asking for documents based on if now we've extended 6 months into your search and you got pre-approved in February, but now it's June and July, we can't just go off of that initial approval letter. Now we need to kind of do the process over again. So this is the reason why preparing when you know you're ready and making the move then is so important, because the longer you stretch out your time, then you're going to have to go through this process again with the underwriter, because they want to see had there been any changes within the last 5 months that it's been taking you to find a home. They want to make sure proof of cleared debts. So if the underwriter says, hey, we looked at, Sarah's credit report and we realized that, she needs to clear up this debt. Somebody has I'm just going to say it may be something like I'm not going to say a charge off because nothing you can do about that. But if your creditor is requesting that you need to make a payment on something, or you're behind a few payments, the underwriter may say, hey, can you get this cleared up? If you can clear this up, it'll change your debt to income ratio, and it may give you, more on your loan, or it may give you a better percentage on your loan. So they want to make sure that you've cleared debts. And not, like I said, a VOE, if we ever hear that from your lender, we need a VOE. That is a verification of employment, and they will need a letter from your job stating that you actually work there and you've been working there for a while. Most employers are familiar with presenting a VOE, so it's not anything extreme that you'll have to worry about. All you have to do is tell your employer, hi, I need, hey, I need a VOE from HR, your manager, or whoever. All right, now we found your home. Your agent has been excellent. They've walked you through every process. We found the home we love. We submitted an excellent offer with that pre-approval letter. Your seller approved it and accepted your offer. And now we've gotten to clear to close. And the final steps with your lender is conditions are cleared, meaning that you've met all of your financial conditions. Anything that your lender may have asked you for or needed from you, it's been provided for them with no hesitation. And the quicker you can get any condition cleared with your underwriter, the better for you. They look at that as you're participating with them, and they want to go ahead and get you clear to close. All final approvals are there, and then you get what's called a closing disclosure. And the closing disclosure, or CD, is where the bank will give you your final numbers. And on this sheet, you will have everything listed there. You'll know exactly what your mortgage payment is going to be. You'll know what your taxes will be. You'll know what your homeowner's insurance will be, which is something you will need to get in order to have this mortgage. So you're going to need that homeowner's insurance. They'll go over any type of fees that are associated with closing. So there will be bank fees. There will be closing fees as far as with the closing attorney. So any type of fees and everything is on this CD, and that is where you and the lender sit down and you go over every single thing so you know exactly what your mortgage payment needs to look like after you close. Any questions on that? You'll have funds verified. They'll make sure that your, the money is in the account to actually close. You will wire that money to the closing attorney or the bank before closing. Normally, you'll wire funds to the closing attorney, and the bank will send the funds directly to the closing attorney to pay for the house. All documents are signed, and then we actually close. Let's see. So basically that is, that's it in a lump sum. Your finances technically tell the story. Our job is to help you make it clean. And again, like we mentioned before, some people are ready right now, and some of us, it's going to take some time, and it's okay. That's what we're here to help you do, help you organize and put all the puzzle pieces together so that when it's time, you're ready. Underwriters, they reward consistency. So as consistent as your finances look and your work history, that's what they reward. Preparation beats last minute fixes. The right loan program, it does matter specific to you. And there are so many loan programs. It's so many. But once the the processor looks at your numbers and your total financial picture, then the processor can say, hey, you might do better with this type of loan versus this loan. So I know you came in for this one, but this loan, based on your financial profile, looks actually better for you, if that makes sense. And location and paperwork matter more than emotions. So let's say you really, I really want to be in this neighborhood. I really want to be next to this place, or I want to blah, blah, blah. And that's great, but your paperwork determines basically at the end of the day where where you can be. I'm not going to say supposed to, but where you can be, because the whole purpose is to make sure that you're buying a home comfortably, and you're not purchasing something that's going to be over your head, or it's going to be hard for you to maintain, because as your agents, that means that we didn't help you properly find the right home for you. We just helped you get in a home. But if you can't maintain it and it's hard for you to maintain, then we failed you as agents. And our job is to help you look at your financial paperwork, look at where you are, and put you in the right position to be successful as a homeowner. All right. So here, if you can, if you're on your phone, if you're not on the phone, if you can, scan this QR code, and we're here to help. Once again, this is the whole point of this webinar, is to introduce people to Core Realty and Associates and who we are. And our job is to not blend in with other agents, but to walk in relationship with you to home buying, to be your support system. And when you think of purchasing a home or anything concerning real estate, generational wealth, that's what we're trying to build here with our team of agents as well as with our clients. And so we want to help you along the way. Each one of our agents are qualified. When you get one, you get all of us. So there's no one over the other. We're all here to help. And we want you to scan this QR code and schedule a buyer's readiness review with one of our agents. And once you scan the QR code, from there, you can pick an agent on there, or you can say you don't have an agent. It doesn't matter. We're all here to help you. We'll teach you what you need to do to pull your own credit and review reports. We are not looking at your credit. We don't want your credit profile. That's not what we're doing. We're here just to guide you through and tell you what you need to do. And we're here to help you organize your documentation, choose a target county, and get strategically pre-approved. And that's our goal. So if you can scan the QR code, if you can't, it's okay. I will email everyone the buyer's form, and you'll be able to schedule a buyer readiness review with one of us at the end of this segment, or whenever you're ready. So now we're here to officially answer questions. Do we have any questions? Or you can unmute yourself and ask questions, and each one of us that are here, we will do our best to answer those questions for you within the last few minutes. And we've gone over time, but we started a little late, so it's okay. So feel free, here's your chance to ask any question. Anybody? Let me see. Can you unmute yourself if you have any questions? I'm sorry.
We got comments from Denasia and Crystal.
Okay.
The webinar was great and that they thank you.
Yay. Awesome. Okay, what do we have? Whose questions first? Comments. You said comments or questions?
It was comment. Those were 2 comments.
Okay.
I don't have any questions at the moment.
Okay. All right. Very good. So if you don't have any questions right now, that's excellent. That means hopefully you're thinking and your mind is churning, and, but we thank you for attending. We hope that, we will hear from everybody, later on. And again, I will email everyone the buyer's form, and you will also have a copy of this PDF, this presentation PDF. That way you can kind of go over some of the files or some of the slides he went through as well. But we thank you all for attending, and we hope that you all will become Core Realty and Associate clients.